The major markets experienced a turbulent week as all 5 indices ended lower. The losses in the final week of January took the Dow, S&P 500, and the MSCI World indices back into the red for the year. For the S&P 500, the drop in the index represented the largest pullback since the last week of October ahead of the election. But the news that captivated the headlines last week was around GameStop, social media, and the action by a number of brokerage firms. Before digging into this, none of what will be covered is considered personalized investment advice, and this does not represent an offer to buy or sell any security. What this does do is offer an explanation of one of the most noteworthy market events in recent memory. For those not familiar, GameStop is a retail company that specializes in selling video games, gaming systems, as well as other video game related merchandise. Additionally, the company is unique in that they buy and sell used video games and gaming equipment as well. The company started trading publicly on the open market back in early 2002. Prior to last week, the stock reached an all-time high back in the early days of the 2007 financial crisis, the high of $63.77. The company, either directly or indirectly, benefited from a drop in the 16 to 24-year-old adult unemployment rate. However, like many companies, the stock fell from these highs as the target demographic unemployment rate increased, and retail stocks suffered. While the company had seen a recovery back to a high of $57.74 in 2013, it never returned to the pre-crisis high in 2007. Since then, the gaming market has changed, with many video game publishers selling either directly to the consumer or through digital sales online. The stock traded to an all-time low of $2.57 in April of 2020. Typically, when an investor intends to profit on the market activity of a company, it does so by purchasing the stocks of a company or going long. The risk to the investor is that the price could fall to zero, resulting in worthless shares and limited risk. Yet the price could increase virtually exponentially, resulting in theoretically unlimited gains in that company. However, another way that one can profit from the market volatility of a company is to borrow shares and sell the stock of the company. This is known as going short. Conversely, to going long. The opportunity for gains is that the price falls to zero, resulting in limited gains. Yet just as the opportunity was unlimited to the long investor, the short investor could have unlimited risk, as the price could continue to rise. At any given point, there is a ratio of stock shorts versus long that is known as the short float of the company. As reported by CNBC, GameStop had more than 138% of the float shares sold and represented the most shorted name on Wall Street. In other words, the stock had 40% more shares sold short than were even available to trade, requiring that a substantial amount of shares would have to be purchased, sold, and repurchased all over to cover all the short obligations. This fact caught the attention of a group on the social media site Reddit. A significant number of investors decided to cause what's known as a short squeeze by purchasing as many shares of the stock that they could to force the price higher. In normal market activity, there are buys and sells. Prices change significantly not by volume alone, but by the amount of one-sided volume either buying or selling a stock. As a result, this significant amount of purchasing caused the price to rise. In a short squeeze, those that had been betting against the stock are forced to purchase shares of the company to close their short positions, adding into that buy-side activity of the stock, causing a feedback loop of sorts, sending the price even higher still, and causing a bubble towards the top of the trade. In the example of GameStop, the company reached an intraday high of $483 a share, an over 1,000% gain from the close of the same day the prior week. The national, if not global, attention of the stock caused a number of brokerage firms to halt additional buying of shares of this stock. Brokerage firms put in place safeguards like this to ensure that they are able to maintain orderly order flow, as well as to limit their own risk by not holding onto too large of a pool of a given security. The market risk in these type of events are substantial, as the price rose as high as 145% intraday and also fell 6% within that same day, representing a range of over 150 percentage points of the prior day's closing value. By Friday's close, the stock had already fallen over 32% from the all-time high set just 3 days prior. The activity in GameStop likely added to the negative returns in the greater market. The reason for this is that when an investor needs to cover a losing position and raise capital, they often have to sell healthier positions to free up capital to cover the loss. Additionally, the news around GameStop muted other financial news in the midst of earnings season. While you may not have participated in this event with GameStop, it's important that you understand some of the underlying market fundamentals so that you can make wise investment decisions with your own money and not take excess risk personally. Finally, last week held the first FOMC conference for the year. In his post-conference video, Fed Chairman Jerome Powell highlighted the ongoing unemployment environment and the delay of another stimulus deal from Congress as further cause to keep interest rates low.